Interpreting and analyzing financial statements is an important task for investors, stakeholders, and financial professionals to assess the financial health and performance of a company. Here are the key steps involved in interpreting and analyzing financial statements. Review the balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. Key items to analyze include current assets, assess the liquidity and working capital management of the company. Non-current assets, evaluate the company's long-term investments, property, plant, and equipment. Current liabilities, examine the company's short-term obligations and its ability to meet them. Long-term liabilities, analyze the company's long-term debt and financial leverage. Analyze the income statement. The income statement shows a company's revenues, expenses, and net income over a specific period. Key elements to focus on include revenue, evaluate the company's ability to generate sales and the trend over time. Cost of goods sold, COGS, assess the company's cost efficiency and profitability. Operating expenses, analyze the company's cost management and operational efficiency. Net income, determine the company's overall profitability and its trend over time. Evaluate the cash flow statement. The cash flow statement presents the inflows and outflows of cash during a particular period. Key areas to consider include operating cash flow, evaluate the company's ability to generate cash from its core operations. Investing cash flow, assess the company's capital expenditure and investment activities. Financing cash flow, analyze the company's debt, equity, and dividend-related activities. Calculate financial ratios. Financial ratios help to assess the company's performance and compare it with industry peers. Key ratios include liquidity ratios, assess the company's ability to meet its short-term obligations. Solvency ratios, evaluate the company's long-term financial stability and debt management. Profitability ratios, measure the company's ability to generate profits and return on investment. Efficiency ratios, analyze the company's operational efficiency and asset utilization. Conduct comparative analysis, compare the company's financial statements with previous periods, industry averages, or competitors to identify trends and benchmarks. Identify red flags, look for any anomalies, inconsistencies, or signs of financial distress that may indicate potential issues within the company. Consider qualitative factors, combine financial analysis with qualitative factors such as industry trends, management competency, competitive landscape, and overall economic conditions to gain a holistic understanding of the company's financial performance. Trend analysis, examine the financial statements over multiple periods to identify trends in key financial metrics. This helps to understand the company's historical performance and forecast future outcomes. Vertical and horizontal analysis. Vertical analysis involves calculating the percentage of each line item on the financial statements relative to a base value, usually total assets or total revenue. Horizontal analysis compares the changes in line items over multiple periods, highlighting significant fluctuations. DuPont analysis. This technique breaks down the return on equity, ROE, into three components: profitability, efficiency, and financial leverage. It helps to identify the key drivers of a company's ROE and assess its overall financial performance. Earnings quality assessment. Analyze the quality and sustainability of a company's earnings. Look for factors such as non-recurring items, one-time gains/losses, and changes in accounting methods that may impact the accuracy and reliability of reported earnings. Industry and peer comparison: compare the company's financial ratios, growth rates, and other key performance indicators with industry averages and its closest competitors. This allows for benchmarking and helps identify relative strengths and weaknesses. Cash conversion cycle (CCC): assess the efficiency of the company's working capital management by analyzing the CCC. It measures the time it takes for a company to convert its investments in inventory and receivables into cash from sales. Debt analysis: evaluate the company's debt structure, including the levels of short-term and long-term debt, interest coverage ratios, and debt-to-equity ratios. This provides insights into the company's financial risk and leverage. Footnotes and management's discussion and analysis: MD&A. Review the footnotes to the financial statements and the MD&A section, which provide additional context, explanations, and insights from management regarding the financial results and the company's operations. Sensitivity analysis and stress testing: conduct scenario analysis to assess the impact of different economic scenarios, market conditions, or changes in key variables on the company's financial performance and viability. Qualitative factors: consider non-financial factors such as the company's competitive advantage, brand reputation, management team, industry positioning, regulatory environment, and macroeconomic factors that may influence the financial results and future prospects of the company. Breakdown of revenue sources: analyze the composition of the company's revenue sources to understand the contribution of different products, services, customer segments, or geographic regions. This can help identify growth drivers and potential risks. Operating margin analysis: evaluate the company's operating margin, which indicates its profitability after accounting for direct costs and operating expenses. Compare the operating margins of the company with its industry peers to assess its relative performance. Return on investment (ROI) analysis: calculate the return on investment metrics such as return on assets (ROA) and return on equity (ROE) to assess the company's efficiency in generating profits from its investments. Working capital analysis: examine the components of working capital including accounts receivable, accounts payable, and inventory levels. Evaluate the company's ability to manage its short-term assets and liabilities efficiently. Capital structure analysis: assess the company's capital structure, including the mix of equity and debt financing. Evaluate the cost of capital, interest coverage ratios, and the impact of leverage on the company's financial position. Inventory management: analyze the company's inventory turnover ratio and average days in inventory to assess the efficiency of inventory management. This is particularly relevant for companies with significant inventory holdings, such as retailers or manufacturers. Customer and supplier concentration: evaluate the concentration of customers and suppliers to understand the company's reliance on a few key relationships. A high concentration may indicate potential risks if a major customer or supplier is lost. Research and development (R&D) analysis: assess the company's investment in research and development activities to understand its commitment to innovation and future growth prospects. Operating cash flow to net income analysis: compare the company's operating cash flow to its net income to assess the quality of earnings and the company's ability to convert profits into cash. Non-financial metrics: consider non-financial metrics such as customer satisfaction scores, employee turnover rates, or environmental sustainability initiatives to gain a comprehensive view of the company's performance and its alignment with broader social and environmental goals. Regulatory and compliance considerations: evaluate any regulatory or compliance risks that may impact the company's financial performance and reputation. This includes factors such as legal proceedings, changes in regulations, or compliance with accounting standards. Risk assessment: identify and assess various financial risks that could impact the company's financial statements, such as credit risk, market risk, liquidity risk, and operational risk. Risk assessment: identify and assess various financial risks that could impact the company's financial statements, such as credit risk, market risk, liquidity risk, and operational risk. Future outlook: consider management's guidance, future growth projections, and industry trends to evaluate the company's prospects and make informed judgments about its future financial performance. Financial statement analysis should be conducted regularly to monitor the financial health and performance of a company. Here are some guidelines on when and how often financial statement analysis should be done. Annual analysis: conduct a comprehensive analysis of the financial statements at least once a year. This analysis typically covers the full set of financial statements, including the balance sheet, income statement, and cash flow statement. It provides a detailed assessment of the company's financial position, profitability, and cash flow performance. Quarterly analysis: review the financial statements on a quarterly basis to track the company's performance over shorter periods. This analysis focuses on comparing the current quarter's results to the previous quarter and the same quarter of the previous year. It helps identify trends, assess the impact of seasonality, and monitor any significant changes in the financial performance. Monthly or periodic analysis: for more detailed monitoring, especially for smaller businesses or those experiencing significant changes, monthly or periodic financial statement analysis may be necessary. This analysis involves reviewing key financial metrics, such as revenue, expenses, and cash flow, on a regular basis to identify any emerging issues or trends. Event-driven analysis: perform financial statement analysis in response to specific events or circumstances that may impact the company's financial position. Examples include mergers and acquisitions, significant capital investments, changes in accounting policies, or regulatory changes. This analysis helps assess the financial impact of such events and make informed decisions accordingly. Ongoing monitoring: in addition to periodic analyses, it's essential to continuously monitor key financial metrics and ratios to stay informed about the company's financial performance. This can be done using financial dashboards, key performance indicators, KPIs, and real-time reporting tools. Ongoing monitoring allows for timely identification of any anomalies or deviations from expected financial outcomes. External reporting requirements: consider any legal or regulatory requirements that mandate specific reporting timelines or frequency of financial statement analysis. Publicly traded companies, for example, need to comply with regular reporting obligations, including quarterly and annual financial statements. It's important to note that the frequency and depth of financial statement analysis may vary based on the size, complexity, and industry of the company. Additionally, ad hoc analyses may be necessary in response to specific business needs or changes in the external environment. Lastly, financial statement analysis should be complemented by other forms of analysis, such as industry research, market analysis, and qualitative assessments, to gain a comprehensive understanding of the company's overall performance and prospects. Thank you for watching. Don't forget to like, share, comment, and subscribe. Should you need help on making and analyzing financial statements, bookkeeping, auditing, billings, and collections, we can help you through Digest IT suite of business solutions. Email us at digestedofficial.ed@gmail.com.